Hello and welcome back to the course on financial management for non-finance managers. Now in this session we'll try to learn cash-based accounting versus accrual-based accounting. What is these two accounting base and how they are different from each other. This is very hot debate always there in the government organization which should adopt accrual-based accounting rather than using cash-based accounting. You can say another way, the difference between government accounting and the corporate style of accounting, how they are different from each other. That is the focus of this session to learn today. So let's understand how government system of accounting work. So you know the government system is being followed the general finance rules, which are now commonly known as GFR rules, which are 2017, which are being prevailing. At the same time, Government of India is also given a manual of audit and accounts. We follow that procedure also, and we also follow in the government public financial management system, PFMS, which we commonly used terms which are used. So that is a system which is there in the government. An accounting period for the government is also April to March. But what is the basis of recording the transaction? So basis of recording the transaction is called cash basis, and this type of system in accounting world is known as single entry system. So what this single entry system is, or what is this cash based income measurement? So here revenue is recognized only when receipt of the cash. That means in the government system we treat something as an income only when we actually receive the cash. At the same time we treat something as an expense when we actually make the payment, that is cash is being paid. It is not being treated as when it is due, we will not treat it that way. We treat only when it is being paid in cash, we say expense happened. When we receive the money, we will say income happened. So it's a cash inflow and cash outflow, but it doesn't reflect the economic effect of that thing, that is the effort which have been put by the organization to earn this particular money. That because you will not get money immediately, you need to put a lot of efforts. You will be, if you're, let's say you're giving services to the society, now for that delivery of services you need to develop a lot of work. You need to develop systems, system people will be working hard, and then a final output is being generated which will be given. Let's say take a case of electricity company. They are producing electricity, firstly being produced, then will be supplied and reach to the masses, then after you will be generating the bill, and then you will be getting the payment from the customer. That is something, the payment to the customer is such a large time, but we are not able to recognize the effort which are being put by the people in the system. That's why this cash based accounting system is having some of the problem, and this cash based accounting system is also doesn't match the revenue with the expenses as we do in the other accounting system. So on the other hand, how the corporate style of accounting work, how they treat, they recognize the effort at each and every stage. The first thing is we recognize the revenue the moment we sell the goods. The moment we transfer the ownership, payment has come or not come doesn't matter, but effort has been done to sell the goods. So once the goods are being sold, we treat them as a revenue happened. And same way we match the similar revenue which is being happened, the income which we are earning, which we are going to earn or being already earned, we are going to match the similar expenses which happened for that purpose. That means all expenses done for that period to earn this revenue will be subtracting this particular amount, and then after we recognize all incomes also which happened other than revenue which we are selling the goods, any other income which has also happened during that period, we also treat them as a particular income for that year. And how we finally calculate the net revenue, net income for the company. So we'll say, or the organization will say revenue minus expenses. So we treat whole operating cycle of the organization which is being there in the organization. So in the cash based accounting system, things are easy and simple because we recognize revenue only when you receive the payment, and same way when we make the payment we treat them as an expense. That is a very simple concept, but in the double entry system or the accrual based accounting system, this concept is little difficult. We have to identify which particular point of the organization or my operating cycle I should treat that revenue is being recognized. Let's take an example to understand it, that we having a production, let's say we having working on a highway project, which is a long project. Now, when should we treat that revenue has happened or income has been generated? Because you are working on a project, highway is being under construction. So unless or until you have completed the whole contract, which will be a 5-year thing or 3-year thing, and once you're completed, then only we'll treat it as this particular thing has become an income. No. Or in the government accounting system, as we receiving the payment, we start treating them as income. That's also not correct. So in accrual based accounting, what we do is we define as a set norms in the organizations, or you can say the industry, we set the norms. This is the particular point, this particular phase will treat this much has become a income out of it. If we have completed 50% work, out of this 50% work, 20% or the rate which you have decided will be treated as a income happened for that particular period. So you may have a different types of industries, have a different types of cycles at which they will define this particular thing as a income happened. Most simple and most common thing which is there is in the retail industry. Retail industry is once the goods are being transferred or bill is being issued, bill is being generated, we start treating them as a income happened. Even payment has been received or not, that doesn't matter. So that is the basis for recognizing the revenue in the accrual based system. So after recognizing the revenue, we try to match the expenses with the revenue. How will we match it? For the matching principle, if the revenues are recognized in let's say X1 period, then all related expenses, both traceable as well as for that period expenses, will be recognized in the same period. So it means once you are able to say this expenses are belong to this particular project or this particular year, so then all expenses which happen during that year will be treated for that particular item to sell, all will be treated as expenses for that year, for the production, for the selling, for the marketing, for the administration cost. All expenses will be for that period will be treated as expenses which happened for that particular year to earn this revenue. So let's summarize our discussion related to accrual and cash based accounting. Accrual based accounting, revenue is being recognized when it is earned or it's realizable. It means yet it is due, so that means will be treated as a revenue. We will not be treating कि जब कैश आएगा तभी हम उसको revenue मानेंगे. This is not the concept. And other thing is expenses are recognized as and when they occur or being consumed. We will not wait for we have yet not paid the expense, we will not treat them as expense. That is not the case in accrual based accounting. On the reverse, cash based accounting, accountant does not record the transaction until cash is being received or actually disbursed. So let's conclude our discussion by knowing some of the important facts about the accounting. One thing which is very important, the accounting figures are for a purpose. You need to define for what purpose you are using which figures. Is it we are using as a cash based accounting, then our purpose is different, because our purpose is to know the cash profit of the organization. And if my purpose is to know the performance of my organization, then this cash based system is not good. In that case, my accrual based accounting system is good. And one more important thing, friends, which we need to remember, accounting figures are not exact figure, these are approximations, because these are the value which you assume this is the value, but this may not be the actual value, because in accounting we record only the what is the amount which is being used as a cost price, but at what we have bought, what is the market price of that is totally different. So maybe different value is there, so we don't consider those things into the accounting. And accounting is do we treat accounting as a evidence? So it's a mean, it is not a evidence in itself, it's a partial evidence. We need to have supplement this information with the more information which is there into the books of account, some of the things which are not financially recorded, those factors are also equally important. But always remember, it is people, those who are making, they are making account, they are the people, not the figures are everything. So figures are not important, people are important. Always consider people first. That is the key message we would like to give. Thank you very much, friends, for patient listening.